Welcome back, ladies and gentlemen. This is our Lesson 5 since we started, and pat yourselves on the back for those who are consistent in our lessons. In our previous class, we passed journals and recorded entries in our ledger accounts. We also extracted a trial balance. Now we need to go to final step, preparing financial statements. But before we do that, there are these concepts that I want us to remind ourselves about, as they form the backbone of financial accounting, and what we learn in these initial stages will be applied in later stages. In accounting, whatever you learn at any stage, especially at the initial stages, are so crucial to the advanced stages of accounting. So let us remind ourselves of these rules or concepts. The accounting equation states that assets equals liabilities plus equity. Double entry concept states that for every debit entry, there must be a credit entry. This we have seen in our ledger accounts. There must be always a corresponding entry to any debit or credit entry. The 5 elements of accounting are affected by the debits and credits in this manner. 1. A debit entry to an asset account increases the value of that asset, and a credit entry on the same asset account reduces the value of the asset. 2. A debit entry to expense account increases the value of the expense, and a credit entry in that account reduces the value of that expense. 3. A debit entry in revenue account reduces the value of the revenue, and a credit entry in the revenue account increases the value of the revenue. 4. A debit entry in liability account reduces the value of the liability, and a credit entry increases the value of the liability. 5. A debit entry in capital or equity account reduces the value of capital or equity, and a credit entry in equity account increases the value of equity or capital. Ladies and gentlemen, know these and have them like your fingertips. The whole accounting process revolves around the 5 elements of accounting, and if you understand how debit and credit entries affect them or their accounts, you are ahead of the rest, and the preceding classes will be much easier to understand. At no point should you, as a student of accounting, say that debit is positive and credit is negative. If you understand how the debit and credit entries affect the 5 elements of accounting, you cannot say or mention that debit is positive or credit is negative. Before we embark on preparing financial statements, let us also learn the accounting conventions and principles. Think of accounting principles as the fundamental rules that provide the backbone of financial reporting, like the guidelines your favorite superhero follows to save the day. These principles ensure that financial statements are prepared accurately and fairly, so investors, creditors, and other stakeholders can make informed decisions. Let's learn about the accounting principles. 1. Principle of conservatism. This principle encourages accountants to be cautious and conservative when reporting financial information. It's like always being prepared for a rainy day by underestimating revenues and overestimating expenses. This way, we avoid painting a rosier picture than reality, which could lead to unexpected surprises down the road. 2. Matching. Principle. Imagine this principle as the perfect duo, Batman and Robin. It pairs up revenues and expenses, ensuring that expenses are matched with the revenues they helped generate. It's all about keeping the financial statements in sync, so they reflect the true cost of doing business during a specific period. 3. Revenue recognition principle. This principle is all about timing. It tells us when to recognize revenue, whether it's when a product is sold, a service is performed, or even when cash is received. It's like knowing exactly when to celebrate your birthday. It's not official until the clock strikes midnight. 4. Going concern principle. Think of this principle as the belief that a business will keep on trucking into the future. It's like having faith in your favorite sports team to keep playing season after season. This principle assumes that a company will continue to operate indefinitely unless there's evidence to suggest otherwise. 5. Objectivity. Principle or principle of objectivity. This principle emphasizes the importance of unbiased, factual financial reporting. It's like being a detective and presenting only the facts without any personal biases or opinions. 6. Consistency. Principle. Like the consistency convention, this principle highlights the need for uniformity in accounting methods and practices over time. It's like using the same recipe to bake your grandma's famous cookies every holiday season. Consistency is key for that perfect batch every time. Now, let's meet our accounting conventions, the trusty sidekicks that help us apply these principles in real-world scenarios. 1. Historical cost convention. This convention tells us to record assets at their original purchase price. It's like valuing your vintage comic book collection at the price you paid for it, even if it's worth a fortune now. 2. Monetary unit assumption. This convention assumes that all transactions are recorded in a common currency, usually the local currency. It's like speaking the same language in the accounting world, so everyone understands the numbers being reported. 3. Materiality convention. This convention suggests that only significant items should be reported in the financial statements. It's like focusing on the big picture and not sweating the small stuff. After all, not every penny needs to be accounted for. Consider a spoilt teaspoon of sugar a 40 kilogram of sugar. The teaspoon amount of sugar is immaterial. 4. Consistency convention. This convention encourages consistency in accounting methods from one period to the next. It's like sticking to your favorite pizza toppings every time you order. It keeps things predictable and makes comparisons easier. 5. Industry-specific conventions. These conventions recognize that different industries may have unique accounting practices tailored to their specific needs. For example, the way a software company recognizes revenue might be different from how a manufacturing company does it. Take an example of bank and an agricultural company. How they account for their revenue is totally different. 6. Time period. Assumption. This convention assumes that the economic activities of a business can be divided into specific time periods, such as months, quarters, or years. It's like breaking down a movie into individual scenes. It helps us track performance and make comparisons over time. 7. Realization convention. This convention dictates that revenue should be recognized when it is earned, regardless of when the cash is received. It's like getting paid for a job well done. Even if the payment comes later, the work has still been completed and the revenue earned. 8. Conservatism convention. While we discussed the principle of conservatism earlier, there's also a conservatism convention that advises accountants to err on the side of caution when there's uncertainty in financial reporting. It's like wearing a raincoat on a cloudy day. Better safe than sorry. So, in a nutshell, accounting principles are the superhero rules that guide financial reporting, while accounting conventions are the trusty sidekicks that help us apply those rules in practice. Together, they ensure that the financial statements are reliable, consistent, and understandable for all stakeholders. Now, let us move on to preparing financial statements, and we will start with profit and loss statement. We had learnt in our previous lessons that profit and loss statement is a statement that measures the financial performance of a business. We also learnt about the 5 elements of accounting. Only revenue and expenses are used in measuring the financial performance of a business. Remember that the financial statements, at their topmost heading, the title must have the name of the financial statement and the period, in this case, profit and statement for the period ended 31st January 2024. Checking on our trial balance, we have all the elements of accounting, but we only need revenue and expenses for our profit and loss statement. Our statement will be arranged vertically, and we will first determine gross profit, which is profit we get, by subtracting cost of sales from sales. You remember how we got the cost of sales figure? By using the formula cost of sales, opening stock add, purchases less closing stock. But in Magdalene's Lemonade enterprise, we did not have opening stock or closing stock. So our sales revenue is $4,000 and our cost of sales is $27,300, giving us a gross profit of $12,700. After getting the gross profit, we will get the list of expenses from our trial balance, which are salary for $2,500, rent for $1,000, electricity for $300, and depreciation for $1,250. We will sum all these expenses and subtract the total sum from gross profit. The resultant figure will be either net profit or net loss, depending on whether it is positive or negative. In our case, we have net profit of $7,650. In accounting, we love using the professional terms that shows we belong to the profession. Like instead of using the word subtract, we use the words net off. So we would be netting off total expenses from gross profit. Ladies and gentlemen, we are done with profit and loss statement. Now let us move on to statement of financial position. We had explained that the statement of financial position is a financial report that shows a company's financial health at a specific point in time, usually the end of a month, quarter, or year. It's like taking a snapshot of the company's financial situation, capturing what it owns, assets, what it owes, liabilities, and what's left over for the owner's equity. Our statement of financial position will be derived from both trial balance figures and profit or loss from the financial performance statement. Here we are looking at the assets, liabilities, and equity. So, we will start with assets. And speaking of assets, we always have non-current asset, that is fixed assets and current assets. Current assets are assets that are expected to be converted into cash or used up within 1 year or one operating cycle, whichever is longer. They are considered short-term assets because they are expected to be liquidated or used up relatively quickly, usually within the normal course of business operations. Examples include cash and cash equivalents, money in hand or readily available for use, accounts receivable, money owed to the company by its customers for goods or services sold on credit, inventory, goods held for sale in the ordinary course of business, prepaid expenses, expenses paid in advance, such as prepaid rent or insurance premiums, short-term investments, investments that can be easily converted into cash within 1 year, such as marketable securities. In our case, for Magdalene's Lemonade enterprise, we have current assets as cash at bank and cash in hand. On the other hand, non-current assets, also known as long-term assets or fixed assets, are assets that are expected to provide economic benefits to the company for more than 1 year. They are not intended to be sold or converted into cash within the normal operating cycle of the business. Checking from our trial balance, the current assets and non-current assets have these values. Current assets, cash at bank for $7,900, cash in hand for $52,000. Total current assets equals $59,900. Non-current assets, Lemonade machinery for $1,375, plastic chairs for $3,000, tent for $1,375. Total non-current assets equals $3,175. Then now, value of our total assets is $9,165 Moving to liabilities, we also have non-current liabilities and current liabilities. Current liabilities are those liabilities that represent the company's short-term obligations that must be settled within a relatively short period, typically within the next 12 months. They help assess the company's liquidity and its ability to cover short-term operating expenses and debt obligations using the current assets. In our case for Magdalene's Lemonade Enterprise, we don't have current liabilities, but the non-current liability. On the other hand, non-current liabilities represent the company's long-term financial obligations that are not expected to be settled within the next 12 months. In our case for Magdalene's Lemonade Enterprise, we have long-term loan of $72,000. So, the total value of non-current liabilities in Magdalene's Lemonade Enterprise is $72,000. Moving on to equity. We said equity is owner's capital, or what is left after paying all the liabilities from assets. In our case, the Magdalene's Lemonade Enterprise, we had initial capital of $12,000 and again, the profit from the business, which is $76,550, totaling to $19,650 as total equity. Now our total liabilities plus equity is $72,000 plus $19,650. That is $9,165. Ladies and gentlemen, now we have our statement of financial position or the balance sheet. From the statement, you can see how the accounting equation has been applied, where the assets value equals liabilities plus equity. This is enough for this lesson for you to digest, and we will continue with cash flow statement and statement of changes in equity in the next lesson. I hope you have learnt a lot in this lesson, and thumbs up for being consistent with our lessons. Thanks a lot for being part of the lesson, and see you in the next lesson.